Welcome to the 3-Edge Week in Review for the week of February 3rd. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3-Edge Asset Management. This week, Steve and I will be discussing a topic receiving a great deal of attention, not only on Wall Street, but seemingly everywhere, and that is the tariffs recently announced by the Trump administration. We'll discuss how tariffs actually work, as well as the potential implications for global trade, the possibility of trade wars and currency wars in response by those countries targeted for tariffs. In market news this week, there was an interesting article from Bloomberg which cited a recent report showing how retail investor sentiment has reached the highest level on record, and individual investors' exposure to stocks is near the highest level it's been since 1997, which was prior to the dot-com bubble bursting. And so perhaps we should consider the report to be a potential cautionary tale. Thought I would put that out there. So let's get started. So Steve, as we know, during the campaign, President Trump promised to impose tariffs on a number of U.S. trading partners. And a little over a week ago, as promised, he announced his intention to place 25% tariffs on goods from Mexico and Canada and an additional 10% tariffs on China. Also during the campaign, President Trump implied that if the U.S. were to impose tariffs on other countries, then those countries would have to pay the U.S. in the form of a tax. However, as we know, as our listeners know, that is not exactly how tariffs work. So let's begin. We'll level set here and explain what tariffs are, how they actually work, and just in general, why might countries impose tariffs on their trading partners?
So, Fritz, tariff is just another name for a tax. And a U.S. tariff would be a tax imposed on a U.S. company for importing foreign goods. So let's use an example, Canada and automakers in Detroit. So in Detroit, we import auto parts that are used in building our vehicles. And when we import an auto part from Canada, if there's a tariff, basically as soon as that auto part reaches the U.S., customs officials, before they release it to the U.S. company, will immediately assess a tax on that U.S. company, whether it's Ford or GM or whatever company it was. So it's a U.S. company that pays the tax. Now, you ask, well, why might there be a tariff? What are the incentives? So, in history, tariffs have been used best when a country wanted to help a brand new industry get off the ground and get some temporary protection so that they can get to critical mass and be more at an economic level where they can then survive and thrive on their own. So that's been one source, one use of a tariff. Another is to try to win negotiating leverage against another country for a whole different other set of issues. And then if they agree, then you remove the threat of a tariff. One problem with tariffs is that even in the case where they're used to help protect a new industry, if they last too long, that industry, because of all the protection, becomes uncompetitive over time. So it's never a good long-term idea anyway. Now, while tariffs can be used effectively, or the threat of a tariff can be used effectively in negotiations, the risk is that in history, what we find is that sometimes the other country doesn't agree with what you want them to agree with, and instead they retaliate and they escalate, and then that's often an outcome in history. So the outcome is not so simple. The tariff is a very simple tax on your own company. The outcome is not so simple.
All right, great. So now let's discuss how could imposing tariffs ultimately lead, and this is what the conversations are, right? How does this potentially lead to trade wars and currency wars? And how could trade wars impact not only global trade, but also the currency markets, the equity markets? And I should mention, in a recent survey, 50% of institutional investors indicated that they believe that tariffs and the commensurate inflation from trade wars will have the biggest impact on markets this year. So it's a big topic. So what could possibly happen here?
So to use an analogy, just as hot wars can start from small beginnings. It could be a simple tit for tat that just escalates, or there could be miscommunication between the parties that leads to an overreaction, and all of a sudden, unintentionally by any party, you have a hot war. Same could be true with tariffs causing a trade war. You can, try to gain a negotiating advantage in some unrelated issue by issuing a tariff or threat of a tariff, and maybe the other country goes along with you and backs down on their issue, and maybe the country calls the bluff and saying, well, we're not going to go along. And in fact, we're going to impose our own tariffs, or we're going to impose export taxes. And all of a sudden, you have potential for escalation. Now, you mentioned currency wars. It's very important. And what we found, not only through history, but very recently, is that when a country threatens tariffs, it's very typical that their currency, their foreign exchange rate, goes up. The country on the other side, their foreign exchange rate goes down. And that completely wipes out and mitigates the effect of what the tariff was supposed to do. So if you raise a tariff to try to make the other country less competitive, but their currency adjusts, then you're back to ground zero. But what you have is a country that has a weaker currency that's now become more competitive on the export market. Other countries see that. They want their currencies to be less competitive. And you have a currency war where all the countries try to weaken their own foreign exchange rate. And that can't happen because foreign exchange is one country versus another. And so you can have a currency war where everyone loses. So that's something to consider as well.
All right. So, as always, my final question is based on what we discussed here today about tariffs, potential trade wars. Should investors consider making changes to their investment portfolios to protect themselves from the potential for market volatility from tariffs and trade wars?
So there's an optimistic scenario and a more pessimistic scenario. The optimistic scenario is that the tariff threats will lead to negotiated settlements on other issues and never come to fruition. But it's too early to judge if that's actually how it's going to play out. On the more pessimistic side, you have this escalation, you have trade and currency wars, and that leads to the potential for stagflation, where not only does global growth slow down, but inflation rises at the same time. That's a very bad mix or brew. When you look at market action right now, it's showing that investors are incredibly complacent about any risks from this tariff or trade or currency wars. Market action shows that it's almost as though there's a 100% chance that nothing bad's going to happen. And I would venture to say that the chances of something bad coming out of all this is more than 0%. There's some chance that this could escalate like it has in the past, and that we could have stagflation result. So we looked hard at what are the hedges or asset classes that you can use to complement your equity portfolio that would be particularly well positioned in the event of the stagflation. And they include gold, they include TIPS, Treasury Inflation Protected Securities, they include commodities, and they include U.S. dollar-based short-term Treasury bills, because if tariffs start to take hold even more, U.S. dollar could continue to appreciate. And so in our portfolios, in our strategies, we include all those hedges to complement the equity side of our portfolios so that we're not being complacent. Our clients can look for some downside protection to the extent that tariffs lead to something worse, not better.
Excellent. And I guess gold reached another all-time high this week, if I'm not mistaken.
You are absolutely right.
Really quite something. Anyway, thank you, Steve. Thank you. Certainly could be a volatile year this year in the markets in 2025. And we will, of course, be right here keeping our clients and our listeners informed through our Week in Review and our View from the Edge videos. So that will do it for Steve and me for this week. Next week, Eric Beagleisen and I will be presenting our monthly 3-Edge View from the Edge for the month of February, and that represents our market outlook based on our proprietary research model. As a reminder, all our videos always available on our 3Edge YouTube channel. If you know someone who you think might enjoy and benefit from our weekly videos, please feel free to share them. In addition, if you enjoy watching our videos and find them to be helpful, please consider subscribing to our 3Edge YouTube channel. We'd be most appreciative. So, until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.